Hello, everyone. My name is Dan Nycklemoe, partner, CEO at Generation Group. Before we do any kind of podcast, there's a few disclosures I must relate. Here they are. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Our guest, David Hedlund, and his company are not affiliated with or endorsed by LPL Financial or Generation Group. Individual tax and legal matters should be discussed with your tax or legal professional. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Thank you so much. Hello, everybody. So David and I have been working together on tax planning with G2 clients, Generation Group clients. David has his own tax practice, so I want to introduce David if you haven't met him personally yet. This is David Hedlund, CPA, someone that Generation Group and has been partnering with. So David, thanks for hanging out and talking about taxes. It's a real exciting topic for everyone, but the reason why we decided to do this brief little cast is that a lot of people have had questions about the new tax bill, the one that was just passed, and the big beautiful bill, I believe is as it's called. And now we want to have a big beautiful conversation. We're not going to inundate you with too many details because this is a little bit more high level, but this is designed to help people get some of the information they need to start taking some action and getting some of the benefits that the tax bill will yield for them, especially starting in tax year 2025. So, David, so we are hearing that the tax cuts are permanent, right? So they're saying these are permanent tax cuts, but there's a little bit of spin there, of course. But so what does that actually mean when they say that the tax cuts are permanent? What does that mean?
Right. It doesn't mean these are the tax rates you're going to be paying for the rest of your life. These don't have a scheduled sunset like when the Tax Cuts and Jobs Act came in 2018. Part of the budget reconciliation process, and in order to get it passed in kind of a special legislative process, they have to sunset certain provisions to just provide some definitency to the budget and what kind of IRS revenue is coming in. This tax bill has a number of permanent provisions that are more or less temporary with like a combination lock on it. New president comes in, Congress changes over, they can change the tax rates, the tax brackets, some of these other provisions with the legislative process. And then there are still some sunset type provisions in this new tax bill, such as, and we can go over that, such as the state and local tax deduction for itemized deductions, and this new senior over 65, age 65 and over special bonus. So there's certain things that are permanent according to the IRS law right now with this new bill, and then there's certain things that will be scheduled to go away after a number of years.
Right, because so the conversation that the tax brackets themselves did not change with the passing of this tax bill. So, right, the tax brackets are still all the same. Can you just elaborate on that a little bit?
Right. It's a little bit maybe misleading. So if we look at 2025 and 2026, the top tax rate still 37%, like it has been for a number of years. Had this bill not passed, the top tax rate in the US would have gone back up to 39.6%. So people may not see a big dip in taxes because of this bill compared to the last several years. Had this bill not passed, majority of people might have been in for a big surprise on increase in taxes.
Right. The surprise would have happened after the end of the 26 tax year, right? Is that how it would have worked out?
Yep. And then so these brackets and the tax brackets are indexed for inflation, and so there's some change throughout the year. But in general, what we're used to as far as like for people trying to peg the 24% tax bracket or this or that, that's going to be the same playing field that we've had since 2018.
So basically the strategies for people that are doing distribution planning or for people who are trying to manage their actually ordinary income tax bracket, those strategies, there really isn't any need for any massive pivots or shifts with how some of those strategies have been playing out for people, because the tax brackets are staying the same. They're not going up like they would have sunset out, right? Moving into the 26 tax year, that's when people would have started going, oh, I am paying more in taxes.
Right.
But now we know, like, okay, things are status quo based on how they were before. Okay.
Yep.
So there really isn't, so there's a lot of fuss about that, right? But so there really isn't necessarily, there have been some changes though. Like, so where are people going to actually pay a little less in taxes? So let's just start with someone who's a solid income earner, or maybe a joint family, having a really good income, and they have kids. So where would you see savings in that environment?
Yeah. So that that cohort of people typically have children. The child tax credit goes from $2,000 up to $2,200 per child, starting for tax year 2025. Now, there is an income phase out where if your adjusted gross income goes up over $400,000, you start to lose some of those credits. So they're going to, by doing nothing and having kids, you're going to have a lot of people will see a little bump in the tax credit. And a tax credit is better than the tax deduction because it reduces your tax liability dollar for dollar. So that's an area. The other thing that will apply to a lot of those, maybe high income
Mm-hmm.
families, they're paying a lot in property taxes. If they're in the state of Minnesota, they're paying a lot in state income taxes.
Mm-hmm.
Vehicle tabs, are not a huge deal, but since over the last handful of years, there's been a state and local income tax cap at the federal level of $10,000. So there will be some strategies on looking at what you might owe for 2025. Instead of paying it in the spring of 2026 with your tax return, can you prepay some of those state taxes and get the benefit in 2025?
So
So
that and that
those are a couple.
that's sorry, that's what people are calling the SALT deduction, right?
Salt.
That's what it's called, SALT,
Yeah, you'll see the
state
salt.
and local tax deduction.
Yeah,
Okay.
and that's been a big deal. And we live in a high tax state, Minnesota, but Californians and New Yorkers and Minnesotans are happier. And for $40,000, it was 10 and up to $40,000. That will impact a lot of people that they'll be able to deduct
Okay.
the lion's share of what they pay to the state in taxes.
So the old deduction was 10, and now the new deduction is 40,000. So it's like
Yep.
it's 4 times as much you can deduct on the state and local tax side.
Yep. And that's one of those provisions that will go away. And I think that it's either 2028 or 2030. So we're going to have a handful of years here where that's available. There are some workarounds for business owners that are still in play and are still
Okay.
beneficial. This one, again, has the income phase out. So I think the number is 500,000 joint filers. You get above that and you start going back down to that $10,000 cap. It won't
Okay.
ever go below 10,000, but so that's where income management, and we're not always a huge fan of tax deferral, but in some instances,
Yeah,
let's
but it
run the
would make
numbers.
sense. Yeah. Yeah.
If you can start deducting more and you get more bang for your buck in 2025 because of these child tax credits or these the state and local income
Okay.
tax deduction, it might be worth it.
So what about people that are on or nearing Social Security? I've heard there's been some adjustments and changes to how that, because the promise was not to tax Social Security, right? Or to increase taxes on Social Security. So what did they do to fulfill fulfill that promise?
Yeah, and so although some headlines will say that this is wiping out tax on Social Security, this new special deduction from the One Big Beautiful Bill Act, that's not necessarily true. Although some statistics from the IRS and the Treasury say that up to like almost 80, high 80% number of Americans may not pay any tax on their Social Security because of this extra deduction.
Okay.
So it's a new deduction on top of itemized deductions or standard deductions, whatever you're taking. This is for 65 years old or older folks in the US here. And again, sunsets, I think it's 2028. So we've got a handful of years here to take advantage of this. It's $6,000 per person over 65. So joint return, $12,000 of an
Okay.
extra deduction. And the income phase out is from your modified adjusted gross income. So that number includes your Social Security benefits you're taking, but your modified adjusted gross income, if it's under $150,000 joint filing, you get the full potentially $12,000 for a couple, and up to $250,000 of modified adjusted gross income, you get some of the deduction, but it's phased out. So if there's people out there that have some massive RMDs coming,
Yeah.
and then this is more in your court a little bit of, or working together in tandem,
Yep.
how do we keep our income low, or are there things we can do to keep our modified adjusted gross income lower so you can get this deduction? Because this
Okay,
isn't
good.
a deferral, this is a free deduction that is you get if your income your income level qualifies.
Okay. So, that and those income levels from a distribution side, they're not that high, right? So like 150,000 modified adjusted gross income in the phase out ends at 250, you said? Was it 250?
Yeah, so above 250,
Okay.
and you're getting zero.
Okay. So the auto loan interest was another thing I think we had talked about. Like, so that was around before, right? But now it's back. So can you explain the auto loan interest deduction?
Well, yeah, and there's still the regulations that have to come out now once the bill passed. Treasury gets together and says, "Here's what we really mean. The law really means." So, my recommendation is, if you're going to buy a new vehicle and you want it to qualify for this auto loan interest, just do your due diligence, and the car dealerships are probably going to be all over this and giving special attention to the cars that qualify for this deduction. But
Okay.
I believe it's outside of it, your itemized deductions or standard deductions. So this would be on a separate schedule from what I'm understanding, and should be available, I think, in the 2025 tax year. So it's one of those things. If you're going to buy a car anyways and you don't care, but you want to get a little extra, sweeten the pot with the tax deduction, let's look into it, or ask some questions and ask around to see if you can get qualified for that.
That's a good transition into this, like for 2025. Now that the bill is passed, the law is in effect for this tax year, correct? So all these changes are now, like, even though it's the middle of the year, they're retroactive from the beginning of the tax year. Is that correct?
Yeah, yeah. And there's certain things business owners are more interested on, some of the things like bonus depreciation or expensing of R&D costs, and some of those things are back to, like, a lot of this is back to like inauguration day, January 17th or 19th of 2025. You put into a piece of equipment into service in February of 2025, and now this new tax bill retroactively allows you to expense the whole thing. And then there are certain things that this bill kind of cleans up, some things that people have wanted to get cleaned up and lobbied to get cleaned up from a past bill. Some disqualifications of some things, and this cleans that up, and it has some opportunities for business owners specifically to go back and kind of take the changes in this tax year that have been, incorrectly done, or like under the old bill, we treated it X certain way. Now this new bill is letting you treat it a certain way, and you can go back and kind of flush it all through this year. So
Okay.
it's not as easy as, like, some are this date to this date. There's just a lot of nuances on when these changes, take effect. But mostly we're looking at the 2025 tax year for a lot of these things.
So then for everybody else in 25, are there things that are going away? Like, are there things you have to do this tax year that aren't going to be in effect for next tax year? So what do people need to be aware of this tax year that they should be focusing on?
They are rolling back a lot of the clean energy credits. So if you're thinking solar panels, which can be up to about a 30% tax credit, those have to be installed by the end of this calendar year in 2025. Electric vehicles are, a lot of people have gotten up to a $7,500 credit for a Tesla or whatever electric vehicle had qualified. That is going away at the end of September, so 9/30/2025. So if there are things you were going to buy anyways, it related to clean energy or some of the home improvement credits, like whether it's AC furnace, whatever, they had some higher end tax credits under the Inflation Reduction Act under Joe Biden, and so some of those things are changing slash going away, and that would be one. Again, a lot of these manufacturers of solar credit, solar panels and all this, they're really on top of the tax credits because it's a selling point. So
Yep.
if you have if you need anything that like a boiler or whatever it is, and you want to get a tax credit for it, it may be something that you want to accelerate from a purchase standpoint. And again, you'd want to look into fine print of what qualifies.
Okay.
So,
Is there anything else like that you can think of, like on the basic people are used to? Pretty much status quo on a lot of the other things. That's pretty consistent.
right. Yep. Like from the itemized deduction standpoint, there's a lot of things that people may remember from just years and years and years of deducting. The employee, there's certain, they kind of shrunk what qualifies for itemized deductions when this new tax bill in 2018 came into effect. And those changes are now permanent. So there's some certainty there, but the itemized deductions gets expanded under this. So there's no kind of cliffs that we need to look out for to take advantage there. It's actually more beneficial to the state and local income tax, the SALT deduction gets expanded. Okay. And things like the mortgage interest, there was a limitation on mortgage interest on what you can deduct if your principal balance is above $750,000. Some of those things became permanent, but again, like no changes from the last several years that people are used to.
So kind of as a placeholder, that, we had talked a lot about this year, between this year and last year, tax year 24, even tax year 23. There was a lot of disparity between withholdings between state and federal, and people were paying into state and getting refunds on federal or vice versa. And there was a lot of confusion about how to get the right withholdings going. And I think we'll probably have a separate conversation just on that, because it's very confusing. And unfortunately, HR and payroll people aren't even really good at helping guide people through it. So what we're recommending, of course, which doesn't probably surprise anybody that's listening to this, is that you should consult your tax advisor, especially mid-year, and do your tax planning in the tax year that you're actually in. Like, do your tax planning for 2025 in 25, not in Q1 of 26. So we're encouraging people, of course, to come back and talk to their CPAs, talk to their tax advisors. But do you have anything there that would help people with like what all the fuss is about? Is there anything that people need to do, like to come and talk to you right away about? Is there anything there?
Well, it's hard to give blanket advice on how to fill out the Form W-4, which tells the IRS and tells your employer what you're going to have withheld out of your paycheck, which ultimately goes throughout every pay cycle to the IRS. The Tax Cuts and Jobs Act in 2018 changed a lot of standard deduction, personal exemptions, all of that stuff, and the payroll withholding internally with the employers and the IRS and how it all speaks together. It really didn't catch up to these changes, and still in 2024, for tax year 2024, we have so many people reaching out saying, I'm constantly under withheld. And that in part, there's been some things since 2013 of some extra taxes on, net investment income, or the high earners on they pay a little bit extra Medicare that's not sometimes taken into account. The best thing to do is, if you are concerned about it, let's run a tax projection, throw your, model out what you're going to earned throughout the whole year. Here's
Mhm.
what you're expected to withhold. Where does that fall? And with this, it's even more important with the new expansion of the state and local income tax deduction. If you're going to be hit with a $5,000 Minnesota tax bill in April of 2026 anyways, can you have the cash flow to pay it in December by December 31st, 2025? Then you at least get to deduct it in this tax year.
Right.
And so that's kind of it's nice for peace of mind, not knowing, I mean, to get some clarity on what you're going to owe, 6 months in advance or 3 months in advance, but there's some extra teeth to it now when you can prepay what you think you're going to owe and potentially get a tax deduction in
Yeah.
this year.
Yeah. So that's why the pre-planning really would come in handy, right? So it would give people the ability to restructure cash flows and get things working so that they can maximize these deductions now and not wait another full tax year to maximize these new
Yeah.
deductions, especially the SALT deduction, the state and local tax deduction,
Yeah.
which
And you
sounds
can
to me
wait.
like kind of conceptually like, sorry to interrupt, but all the things that were changed with this bill, this seems to be the biggest impact of in the bill is the state and local tax deduction. Is that kind of the general consensus?
I would say for individuals that are not individuals plus individuals that are over 65, because could they get an extra, could they be itemizing with this extra state local income tax and get this new senior bonus deduction? Um, it's almost like it's hard because if you're making too much and you have a lot of state income tax, you're probably going to be phased out of that senior bonus deduction. So, but it's where do you fall on that spectrum type of thing? And then business owners, that's a whole separate
Yeah.
conversation because there's a
Yeah.
plethora of provisions in here that we're excited about from a business owner
Yeah. That might be
standpoint.
another good kind of sidebar to have. So kind of talking about where we're going with some of these tasks where we're doing these is we're really here to just try and create some awareness and start conversations to help people understand why having these conversations with your tax advisor or having these conversations with your financial advisors are good because they're not we don't know what we don't know. And also the more actively engaged we are together, working together in concert, we know there's a better result because if you know how this works, David, because I mean, it's like if you're not paying attention to it, then you can only react to it. And by the time we're reacting to it, it's too late. So let's try and accelerate the fact that now if oh, I can get these extra deductions, hopefully that will create enough urgency with people to do the work now to figure it out because the way we structure the way that we do our tax work, of course, is that it's more of it's a project based. So it's not like having you run a tax calc costs the client a bunch of extra money. The interesting thing is there's a full ROI anytime we're running a tax calc because we're getting the clarity we need to figure out what the extra deductions or actions should be to cover all the costs of doing these types of things. So if there's an integration of advisory that I think really does help clients and individuals save more money on taxes. And when we mean save, we actually mean these deductions are actually saving you money on taxes.
Yeah, yeah. There's a lot of things in here, and what I'm telling people right now is like it always helps to have a baseline of, well, here's what you're gonna potentially owe, and what gets measured gets improved. So that we have a baseline. If you don't like the result, we have half a year to implement some things to change it. So that's really where there's been and this bill really can hopefully spearhead a lot of people into having these conversations in July and August and not October, November, and rush in
Yeah.
December. And then there's a certain group of people that are going to be, they're going to do nothing. And we don't know with this, like maybe you come out and you are in a better situation than you were in 2024 from a tax perspective, because a little bit more change in deductions and maybe you're used to paying in 10 grand and it's 7 this year. We don't
Yeah.
know, but if
Yeah.
you're looking for the clarity, so you're not kind of sitting on the edge of your seat until April of 2026, like we're here to run the numbers now so that
Yeah.
you have some clarity, and then we can do something about it.
Also want to encourage everybody that's taking the time to listen to this that, if you have questions, just send them over. We're happy to answer the questions. We're a resource first. We're here to advise first before we take any action on anything. So keep that in mind that a collaboration is the key. And the more we collaborate, the better the result. All right. So David, thanks for the kind of round robin on this. Like I said, we may post some more stuff about just other things to do, but this was really helpful. And we hope this is helpful for everybody else that's taking the time to listen to it. And we look forward to staying connected, and we look forward to having everybody as part of our community. So thank you to all of our clients. Thank you to all our friends and prospects. And also thank you to you, David, for the great work you're doing for your clients and our clients. And, you know, the cool thing about our collaboration is it's a great merging of foundational practice with management of wants and needs and creating the best outcome possible for clients. But you know, we have to follow these rules and the rules are always changing. So it's good for us to know what the rules are. Okay. So David, you're the man.
Thank you, Dan.
We will be in touch, of course, and look forward to seeing you guys on further casts later. All right, everybody. Thanks a lot. Bye-bye.
Take care.